Welcome back. It's time now for On the Radar. That's when we ask an investing professional what they're looking at in today's markets. Nadia Lovell is back with us from UBS. She's equity strategist, global wealth management at UBS in New York. To talk about, Nadia, your views on European stocks. As we noted earlier, European stocks have done very, very well on an index basis so far this year. From what I'm seeing, you don't think the story's over. You see several different narratives, 6 that you identify for clients on why the U.S. equity picture is attractive. Why don't we begin with increasing investments in security by many countries in Europe, perhaps most notably Germany, which has taken the somewhat historic step of ramping up defense spending in a big, big way and adjusting its approach to budgetary deficits in a bid to do so.
Absolutely, Paul. You know, we did have, coming into this year, we did have a positive tactical view, specifically on Germany, on the DAX. You know, we've since closed out that view, and that's because we're taking, as you mentioned, a more selective approach around Germany. You know, as you noted, Germany has passed that 500 billion euro special vehicle fund to focus on infrastructure investing, and also has released its defense spending from those strict fiscal restrictions in terms of allowing for more spending on defense that are not subject to the debt brake. And so we think that all of that means that you're going to see an increase in spending in Germany that is going to benefit defense companies. So this is why we also upgraded in February to an attractive European industrial companies that we think are going to benefit from all of that incremental spending. And that's not just limited to Germany. We've also seen it across Europe with the U.S. pulling back and the rhetoric around the U.S. pulling back its support for defense spending in the region. We've seen the region really step up. I mean, in fact, we've, as you've seen that 800 billion euro potential incremental increase in spending across the region. And all of that is going to benefit these defense companies. And so that's why we're taking a more selective focus on specific companies across those 6 frameworks that you alluded to earlier.
One big reason that European countries are taking a different view of their security needs is the war in Ukraine, of course. You think also that ultimately there'll be a big push to rebuild the terrible destruction that has happened in Ukraine, and that's another one of the narratives at play here.
Absolutely. You know, of course, the peace deal between Russia and Ukraine, we all have to admit, remains highly uncertain. But we do think that you ultimately get something this year. The U.S. has been doing its part in helping to push for that. And we know that this has been a war-stricken country for the last 3 years. And so we think that rebuilding effort will start to happen after a peace agreement is reached. That should be incremental positive for materials construction companies as that happen. There's also a potential for lower energy costs. We know that natural gas prices have remained elevated in Europe. Yes, they've come down from that spike that we saw right after the invasion of Ukraine, but they still remain above the levels they were pre-war. And so as those prices potentially come down, that's a positive for areas like Germany, which are heavily industrials. And so we think that a peace deal could help to boost some areas in Europe and be beneficial to those sectors that have exposure across that framework.
What about global trade risks? How do European companies fit into your view of the potential for a global trade war?
Look, like I alluded to earlier, we think that, there will be reciprocal tariffs on Europe. And I think that we do think that it's going to take a longer period of time for that to be negotiated because the Trump administration seems to have a long list of grievances with Europe, particularly around, digital service taxes, also Europe being a safe haven from a corporate tax standpoint, particularly countries like Ireland, and also the potential for for the fact that you've seen ban on agricultural products into Europe, and also overall higher tariffs on some of our products. And so we think that it's going to be a long negotiating period for Europe around reciprocal tariffs. And that's why we're also focused on those companies that we think that are going to be more insulated, those more domestic facing companies. So think about like financials, as well as some of the healthcare services companies that could be more insulated from a global trade war with the EU.
So the run up in the indices, the FTSE 100, the CAC 40, and the DAX index does not dissuade you from viewing stocks as attractively valued in Europe.
Yeah, so our approach, again, is more taking a selective approach. It's not to say to go out and buy broad Europe. We're actually neutral on broad Europe. It's a select basket of companies that we have really curated for our clients, where we identify companies that we think will benefit across those 6 themes. So, increasing defense spending and security, the rebuilding of Ukraine, the potential for lower energy prices, as well as the potential for a cyclical recovery in Europe, and also those stocks that are more insulated from global tariffs. And so it's a highly curated basket. It's not a sort of go out and buy everything in Europe. It's a very more targeted approach.
Nadia, thank you so much for everything this morning. It's always wonderful to have you on our show. Nadia Lovell is